Hello, people. We're back for another Hump Day update.
Woo!
It is July 6th. July 6th. Let's get that right.
You're a fucking idiot.
July 6th, 2022. And let's just start off with a little recap of last week. So, the Fed vowed that its sole purpose is killing inflation. A little delayed. We'll work on it. And it doesn't see every sign of recession. It doesn't see that looming in the near future, which is a little crazy, but that is their stance, or was their stance. We also had the market close the first half of the year with its biggest decline since 1970. Definitely big news. And then Europe and the ECB were met with widening credit spreads and the challenges that come with that. They have to address that while still trying to tackle inflation. So they're really stuck between a rock and a hard place. We'll see how that plays out. But yeah, let's get started. So, top stories so far. The dollar rallies to, I think it was a 19-year high. But that's a big news. I mean, I think the DXY is almost at 107 right now, which is pretty crazy. Got a lot of people getting squeezed who have dollar-denominated debts. You know, if their debt is in dollars, it's increasing relative to their currency. So that is a huge deal. But yeah, the dollar rallies to a 19-year high as Fed tightening continues and flight to safety also continues. The market is starting to price in a global economic growth slowdown, so that would explain kind of why people are fleeing to the dollar. And they view the Fed as being comparatively more aggressive in its tightening than some of the other countries like the ECB or what have you. So that explains why the dollar is appreciating relative to other major currencies.
Totally.
Right. All right, so next story, and then this is another big one. So oil dropped about 10%. I think it was actually 11% if you include today, below $100 as recession fears mount and loom. Ooh. Yeah, but so recession fears are gaining a little bit of traction, and supply concerns, because that's been the story of oil recently. The supply side of the story that's contributing to all this, you know, the price appreciation, is starting to take a backseat to the demand destruction that people are projecting in the future as the economy slows down. So demand goes down, oil maybe isn't as needed, so the price is kind of reacting. And that's what we saw. So yeah, about 11% decline, huge move. Definitely probably with the highlight, in my opinion, of the market this last week, Tuesday and today. And then next story, we got bonds also flashing a little bit of a recession warning as people again continue that flight to safety. So, but it's kind of coming in conflict with the shorter end of the yield curve. So the shorter duration maturity bonds. The yield curve actually inverted again, the 2s and 10s once again inverted, signaling the bond market sees the light at the end of the tunnel with regard to the tightening cycle. The Fed is still hawkish, but the market doesn't see the terminal interest rate really getting much higher towards the end of the year if a recession ends up squashing inflation quickly. Obviously, it's anybody's guess what actually happens, but that's a bad sign. I mean, whenever the 2s and 10s invert, that is historically a sign that a recession is coming, and this is not the first time. So it's not like it happened and then it stopped. This is it's a repeating occurrence. It's happening, you know, I can't remember the exact number, but it's happened several times now. So definitely a flashing recession warning light from the bond market that you'll want to keep an eye on. And then next up, we have Biden is actually considering removing Chinese tariffs to try to combat inflation and some of the price problems that we're seeing. So Biden is considering removing Chinese tariffs, and this would help in reducing the cost of Chinese imports, which, as we know, is a lot of imports for consumers, especially in America. But it would also severely disadvantage domestic producers who can't really compete with China. Which is why Biden has actually gotten a lot of pushback. He is generally viewed, self-acclaimed, a pro-labor union president, and this is obviously kind of counter to the labor union movement in the United States. because it's going to hurt them. You know, they can't really compete with Chinese prices. So if he cuts tariffs, it might help in the short term combat inflation, but at the same time, you're going to be harming a lot of domestic producers. So not exactly ideal, especially for someone who does claim to be so pro-union. And next up, we have the market patiently awaits the Fed minutes, which is actually later today. So we'll get some clarity around the recent decision to raise rates by 75 basis points and possibly some clues about the next interest rate decision and the Fed's overall assessment of the economy.
Oh, hell no!
It's not looking good, that's for sure. We're heading somewhere not good, most likely. That said, they don't really see that. They are, you know, it's somewhat self-serving, I guess, because they want to combat inflation, but they're not really talking too much about recession as being a huge possibility.
Not crazy.
I'm telling you. But yeah, so let's actually run through some of these prices. So on the week, we have the Dow Jones down not quite 1%, call it 75 basis points. SPY up close to 1%. NASDAQ is up a little over 1.5%. Russell down about 0.5%. 10-year yield has had a rough week, down a decent amount as people fly into bonds and bring those yields down. But still, for the week specifically, only down about 40 basis points. VIX trading a little bit higher, not crazy, just a little over 1%. And then the dollar, as we mentioned, the dollar index up about 2% just this week since Monday, Tuesday. So it's obviously a huge move and part of a much larger move that has been going on for a long time. But now let's transition over to foreign markets.
Oh, yeah!
Preach. Okay, so Eurozone inflation hits record 8.6%, and the euro drops 1.8% against the dollar to a 2-decade low. So this is obviously a factor among many contributing to the euro's decline, but the ECB is preparing for its first rate hike in 11 years and is potentially headed to a nominally positive interest rate by the end of the year. And let me repeat that, nominally positive, because obviously inflation is at 8.6%. So their interest rate right now that isn't even positive. You know, they've been running with negative interest rates, call it negative, 25 basis points, 50 basis points. So they are just potentially going to be going positive nominally by the end of the year. I mean, that's crazy, trying to reconcile those two things. It doesn't even make sense. I mean, they think they're going to combat 8.6% inflation with 0% interest rate.
Damn!
No, not happening. But yeah, so this is big headline. I mean, inflation obviously on everybody's mind, and 8.6% is not a small number. It is. It's definitely not going to help them in this just quandary they found themselves in. But yeah, so first time in 11 years, and they will potentially, just depending on how things develop, be going for a nominally positive interest rate by year end. We'll see. Next up, on a similar note, we have the British Pound, Great British Pound, GBP. Gotta get my acronyms right.
You're a fucking idiot.
So also struggling a lot against the dollar. Hit a 2-year low against the dollar. So much like the ECB, the UK is battling with pretty aggressive inflation, grappling with inflation at 40-year highs. The Bank of England's chief economist actually said Britain's economy will likely slow to a crawl over the next year, though it still has plans to continue raising interest rates. I believe they have plans to raise by 50 basis points at their next meeting. So despite among central bankers, it may not be broadly consensus, but for the most part, everybody is starting to acknowledge that there is going to be an economic slowdown, downturn, what have you. And despite that, they are still remaining, most central banks, if not all, and pretty much most, are remaining steadfast in their fight against inflation. So economies might be slowing down, but inflation is so high that they still got to remain pretty hawkish. And yeah, so this is leading to a lot of currency forex rates just plummeting relative to the dollar's value. Next up, we have emerging markets. So emerging markets post longest streak of monthly outflows since 2015. The global flight to safety and aversion to risk assets is driving investors away from more speculative markets, which includes emerging markets. You know, flight to treasuries means you're leaving all these other markets that have, just playing out more speculative markets. It's just not the same. They don't have the same liquidity. And, when you are worried that there's going to be a downturn, you're not trying to hold an Italian bond or whatever it is, an Argentinian bond, not that you ever would want to hold one of those, but that is leading to a lot of outflows of emerging markets and predominantly into stronger, more safe markets like the US Treasury market, etc. And this is technically excluding China, although they have had, I believe, net outflows for the year recently. They've been having more inflows, I think specifically to the equity market in China, but still, in a more general sense, the emerging markets are getting hit. All right, let's shift over into commodities. Obviously a hot topic right now, pretty big deal. So Saudi Arabia is boosts its official selling price for oil to a near record level, and OPEC Plus sticks to its previously planned output hike. Jesus, what is happening? Previously planned output hike, despite relatively strong demand in Asia, the US, the UK, which are all, for the most part, urging further increases to bring down gas prices. America specifically. That's what Biden's. Him and honestly, Chair Powell have explicitly said that they are tackling gas prices, oil, and this is something that they need to do. They want OPEC Plus to increase production, and it's not really happening, unfortunately. But getting record profits over here in Saudi Arabia, good for them, right? All right, so let's transition specifically to the Biden aspect of this. So President Biden is going to be headed to the Middle East in mid-July for a number of things. He's also meeting with Israel, I believe, but unrelated to commodities. And while he's there, he says he will not be asking Saudi Arabia to increase oil production, despite obviously wanting them to increase production. He doesn't have plans to explicitly ask them or even to meet with the Crown Prince. And I think a lot of this has to do with, for lack of a better term, measuring dicks. They just don't really want to appease the other or come off as like they need the other. He doesn't want to bend the knee, so to speak, to the Crown Prince, and the Crown Prince is in a similar boat, thinking he is the one with all the power. So I think there's a lot of political games going on. Neither of them really wants to appease the other. So very concerning though, because obviously he needs OPEC in Saudi Arabia to increase production, but he is maybe a little bit too proud to do that. We'll see if he actually ends up meeting with Saudi Arabia or the Crown Prince or anyone else in the Middle East, specifically related to oil, to increase production. But as it stands right now, it doesn't look like he is going to meet with anyone to explicitly ask for increased production. What? Yeah, so good luck at the pump, everybody. All right, next up, we have the EU Parliament backs labeling gas and nuclear as green or climate-friendly energy sources. So this will help promote building out gas and nuclear infrastructure in the short, medium term. And the EU suggests that this is a temporary decision to combat the energy problems, inflation that they are experiencing. But there is still a lot of pushback among the different EU states, obviously because they don't want to start. They believe this is sending a bad signal to the world writ large about its, I suppose, approach or willingness to commit to climate-friendly policies. But obviously it's a lot more complicated than that. They have crazy energy prices right now, so they're trying to bend the rules, if you will, to include gas and energy in that. But like I said, yeah, a lot of pushback, so we'll see how that develops. And then now we can switch over to some prices, commodity prices. Let's just touch on this real quick. So oil, like I mentioned, is down a little over 11% for the week, down 2% today. Natural gas down almost a little over 3% for the week, up a little bit today. And gold down 4% for the week, down about a little over 1.5% today. Silver down less than gold, surprisingly, about 3%, 43 basis points. And then I don't have any stories about cotton, and maybe nobody cares, but it's down 8.63% this week, and a lot more over the last couple weeks. So I just thought I'd mention it just because it is a sizable move, possibly indicative of the broader economic downturn that people are expecting, recession fears, etc. But let's get back to these stories. So we'll go ahead and transition to the wild, wild west of crypto. So in the crypto market right now, we're having some pretty crazy liquidity crises, right? Everybody is insolvent, and people are going,
And we say bye-bye.
real quick. So you got people who are more capitalized, in this specific instance, Nexo. They are starting to use their, quote unquote leverage. They could say they have all this extra money. They're not facing insolvency like a lot of other firms, funds, companies, etc. So they're starting to buy out, consolidate. The crypto market in general is starting to consolidate, with the large players who have the money and ability to buy out competitors are doing just that. So the crypto lender Nexo right here, they offered to buy rival Vald. Wasn't even familiar with that, but probably a sign of why they're struggling. So contagion in the crypto market and the corresponding liquidity crises are forcing a lot of companies to make deals with bigger players just to stay alive. The companies and investors who have money are using it to their advantage by providing the liquidity that everyone desperately needs in exchange for ownership or aggressively favorable deals. This is obviously true of FTX CEO Sam Bankman-Fried. He's been making a lot of deals with Celsius, BlockFi, etc., big players, to provide credit lines and give them the liquidity they need in exchange for lots of things, but equity or just very favorable terms with the deal. It's kind of like a Warren Buffett style thing. But yeah, crypto market is consolidating, which is ironic because it runs counter to the kind of decentralized ethos. Let's see. So next story. Let's transition. Let's keep the ball rolling, guys. Let's do it.
Oh, yeah.
So JP Morgan says Bitcoin miner sales may keep pressuring price. So this is a pretty big story. So lower Bitcoin price plus higher difficulty adjustment as the hash rate kind of moves higher, and higher energy costs with inflation are putting pressure on miner margins. Meaning they're not really making a profit because the cost of production is starting to line up with the price of Bitcoin. So it dips below, they aren't really profitable. So they're starting to unplug miners and sell assets. And this is at least partly responsible for, I don't know if I actually have this. I don't have it up here. Partly responsible for the firm Core Scientific selling about 167 million worth of its Bitcoin holdings in June. And they're not alone. I believe there's some other firms that are doing the same thing. They're struggling. They got to raise capital, so they're unplugging miners, selling assets, including Bitcoin, putting downward pressure on prices. And just the broader the crypto market more broadly. And this could easily continue. I mean, what we're probably going to see is a lot of these less efficient miners squeezed. They aren't able to stay profitable throughout all this chaos, so they are going to be forced to sell, liquidate, etc., and the miners who have low cost of production, who can weather these low prices and the turmoil in the crypto market, they will survive. But a lot of the weak players are going to get squeezed out because they can't afford to mine Bitcoin if their cost of production isn't substantially lower. So right now, I think you have a lot of miners, plus or minus that 20K level, who are really struggling to remain profitable. So you're probably going to see a lot more of, actually I think I have the second story I can pull up right here. Yeah, this specifically. So yeah, Core Scientific. So you're probably going to see a lot more companies like this who are struggling to remain solvent. They need to sell assets, sell Bitcoin, sell mining rigs, etc., just to stay alive, or they just fall off because who knows how long they would have to weather this. I mean, if you can't get your cost of production down, you can't get it down. There's a lot of complicated things that are involved in that. Could just be location. You have to get, you know, a lot of miners, they get free energy. Well, not free energy, but wasted energy. So for next to no cost, because it otherwise would have been wasted. So whatever company would be wasting it is happy to sell it for next to nothing because they're at least making something off it, right? But yeah, get used to this. We're probably going to see a lot more of it in the future, unfortunately. But you know, the strong survive. That's how the market works, and hopefully we come out better for it. All right, and then the last crypto story I got: Celsius repays 183 million of debt to the DeFi protocol Maker. So it paid down debt to get back some collateral and pushed down its liquidation price, which was kind of a headline thing going on for, you know, rightfully so, it made sense. But basically, if the Bitcoin price, at one point, I think it was maybe like $17,000. If Bitcoin dropped to 17,000, they would be liquidated. So they were obviously rushing to lower that liquidation price. They're scrambling to get cash so they can meet customer withdrawals. A lot of people, you know, bank running, they're just taking their funds out. But this loan repayment will push down its liquidation level to about 2,800. So Bitcoin, you know, I'm assuming won't get that low, so they probably would be good. But they are now close to 10 times over collateralized after paying down that, you know, paying off some of that debt on Maker. We'll see. I mean, maybe Bitcoin drops to below 3K. I really doubt it, but I will be a buyer at that point, probably. All right. But that about does it for the news. So we have some stuff coming up next week that is important. Specifically, we got the non-farm payroll or unemployment numbers that are released Friday. That's going to be a big deal. Obviously, unemployment plays a pretty important role in the Fed's calculation. I mean, their mandates, explicit dual mandate of price stability and unemployment, so they kind of view those as like two sides of the same coin, despite their focus being inflation right now and price stability. Obviously, if something crazy emerges from the labor market, unemployment numbers are substantially higher than they thought. They maybe changed their stance a little bit on inflation. It's hard to say just because they've been so hawkish, but you never know. They could have a little pivot.
Right.
All right, and then also we have, like I said, President Biden is set to travel to the Middle East in mid-July to speak with OPEC nations about oil production. That's an important thing to keep an eye on because oil is kind of contributing to a lot of the turmoil in markets in general. And as I also mentioned, it is the focus of the Federal Reserve right now. They are explicitly targeting gas prices, oil inflation. So any big moves in the oil market with regard to increased production is going to be huge. And then finally, we have June CPI numbers come out next Wednesday. That's honestly more important than the unemployment. So definitely keep an eye out for that. The Fed is obviously looking for a lower rate of inflation. Something tells me we won't see anything remarkably lower, even if it is lower. It's definitely possible. That said, that's not going to let them or make them take the foot off the gas. They are adamant on several prints demonstrating a prolonged decrease in inflation. They want to see the rate of change, the second derivative, demonstrating or showing that inflation is slowing down. So one print is not going to be enough. It's not going to save markets. I mean, maybe if it was what was the last print? It was almost 9%. We'll call it a little over 8.5. If it came down at 6%, that would be pretty crazy. Maybe they changed their tune, but don't see that happening. That would be pretty wild. But anyways, just something to keep in mind. June CPI numbers out next Wednesday. Unemployment this Friday. And then this is not as pressing, but Biden traveling to the Middle East soon. So that about does it for today, guys. We got a little... Thank you. All right. Well, stay happy, humble, and solvent, and happy trading.